years ago, I published my third book, Wall Street Potholes. Each chapter discussed an investment product that is rarely as good as it seems. Often it's retail investors that get ripped off. Smart people who have been successful in life but not in finance, so they don't always know what to look for. Non-traded REITs or real estate investment trusts got me thinking about this book because a client came to see me who had been screwed by one of these nasty little scams. I've written about them on our blog so you can learn more there. But fortunately, because many other market observers like me called them out, the SEC began to crack down and non-traded REITs are slinking off into the ignominy they deserve. The other day, a good friend showed me an interval closed-end fund that he owns. Closed-end funds are a curious little backward of the financial markets. They generally invest in publicly traded stocks and bonds, but unlike mutual funds and ETFs, they have a fixed share count. So their price doesn't have to equal the net asset value of what they own. They usually trade at a discount, and because they own listed securities, it's easy to value their holdings. They're just not that big or liquid, so it's hard to deploy hundreds of millions of dollars in them. Mostly self-directed retail investors trade them. My friend showed me an interval closed-end fund that an advisor had put him in. Interval funds don't trade at all, so you can only get out when the fund offers to buy your shares back. Typically, they do so on a regular schedule, such as quarterly. SEC-registered funds are supposed to provide liquidity to their investors. Interval funds often invest in private equity or debt instruments, which are not that liquid but qualify as being appropriate for anybody because of that offer of regular redemptions. A normal private equity fund locks up its clients for several years, invests their money and pays them back over as long as a decade or more, depending on when they exit their investments. Interval funds straddle this liquidity mismatch. They make illiquid investments and can meet redemptions as long as everyone doesn't want their money back at the same time. They can invest in just about anything, from a late-stage company to a speculative biotech startup that will probably fail. It's a bit slick. Managers have successfully argued to the SEC that this allows retail investors access to sectors that are normally only available to wealthy accredited investors and institutions, as if this group somehow does better than everyone else, which it's not clear that they do. There are some interval funds run by well-known firms, such as the PIMCO Flexible Credit Income Fund. It's returned 2% per annum over the past 5 years, and also paid itself 2% in fees. So if you're not in this fund, you're not missing much. Because private equity and debt are illiquid, investing there requires more due diligence because it's hard to get out if you decide you've made a mistake or just want your money back. I don't think interval funds are a great deal because they're illiquid, opaque, and complicated, and don't compensate for these shortcomings. For the vast majority of investors, public equities and government bonds provide everything you need. Because of the disadvantages of interval funds, it's especially important to invest with well-known firms. They'll have done the necessary due diligence on the portfolio managers they hire, will have access to deal flow, which is vital, and will behave appropriately if things don't go well. Smaller interval funds are to be avoided. The Wildermuth Fund is a case in point. Currently in liquidation, it was run by Daniel Wildermuth and was chock full of illiquid private equity and debt. Its size varied from $100 to $200 million in assets in recent years. I don't know how they'd ever compete with big firms on deal flow. They'd see the transactions the other guys didn't want. Wildermuth also owned a broker-dealer called Kalos, based in Georgia, which filed for bankruptcy last year. They'd been selling GBP Investments, whose CEO was charged last year with running a Ponzi scheme. Kalos went bankrupt because of the numerous lawsuits they were facing. Because of their own bad investments, the Wildermuth Fund suspended withdrawals, and just the other day they fired Daniel Wildermuth as fund manager. Daniel Wildermuth was obviously not very good at investing. Overall, I don't think interval funds belong in the market. They promise liquidity that they can't always deliver. But small interval funds require substantial research to justify an investment, and I doubt it's worth the trouble. The Wildermuth Fund is an example of why. If you're interested in learning more about the energy sector and interest rates, then don't forget to subscribe and follow us on LinkedIn and Twitter. Our handles are in the description box below. To find out more about what we're thinking, you can sign up for our twice-weekly blog at sl-advisors.com. We always love to hear from you, so if you have any comments or blog ideas, please leave them down below. I'm Simon Lack. Thank you for watching this video.